Hello, everyone. Zoran here from Hot Property Buyers Agency and Your Empire here in Brisbane. Well, it is month 2, February 2026, and I'm joined by Chris Gray from Your Empire in Sydney and Lauren Staley from Infolio in Melbourne and Your Empire in Melbourne. How are we doing, team?
Yeah, it's all good. Sun shining in Sydney. Hopefully the market's looking positive.
Yeah. Well, look, I know it's on fire up here at the moment, and we're definitely seeing a lot of buyer activity. How do you guys feel about the interest rate rise kicking 2026 off?
Well, interestingly for me, I haven't had any conversations with people about it. It sort of seems like a bit of a moot point. I think there was expectation that it was coming. So most astute people, homeowners or investors have already accounted for it, and they're doing so with their numbers anyway. So it really has been a bit of a non-event as far as I can say.
Yeah, I mean, the main thing we see is people concentrate so much on the media as to when to make their property decision. And of course, for the whole of last year, it was saying, oh, we're going to get 3, 4 or 5 rate drops. And then people, again, they use that as an excuse. I'll wait till it kind of hits in and wait till it changes. And they delay their decision. And then suddenly they start talking about a rise and they say, oh, we're not going to get any more drops for the next of 2026. So it chops and changes every day. No one can predict the market. And that's why we've always said the same thing for 20 years. You've got to be in for the long term. If you've got the money, now's the time to buy. Don't wait for the next day because there's always something that will stop you doing it. And you look back in a few years and you've done absolutely nothing.
Yeah, for sure. Look, obviously I've got enough debt to look at interest rate rise and get a bit annoyed as well. But I actually look at a rise as a positive thing as a buyer's agent in some regards, because hopefully it flushes out a little bit more supply from those sensitive, cash flow sensitive sellers. And then maybe also some of those on the fence buyers, you know what, you stay on the fence because I'm buying, right? So if you want to get out of the market and mean less competition for me for the next month or two, go for it. But I think that they're missing opportunities. And I think in this market, while it is hot and prices are rising, there's buying opportunities in every market. I got one over Christmas below bank val in an off-market transaction. Just got one yesterday, contract being signed today, about 50K below my client's budget and expectation. So deals are still coming through really, really strong. But Chris, do you want to jump over and bring up the CoreLogic results? Let's look at what it actually is translating like in real numbers. So Sydney, 0.2% for the month, same for the quarter, and 6.4 annual. Melbourne, 0.1% for both months and quarter, 5.4%. Brisbane, Hockey Toledo's 1.6 for the month. Watch out. 5.1 for the quarter and 15.7 annually. Another standout there is Perth, just to note as well at 2%. But guys, I guess a little bit subdued. I guess I'll jump straight to you, Lauren, because I'm genuinely surprised that this growth rate is so low when I look at what's actually happening in your market.
Yeah, really, really interesting. We found that our market shut down earlier last year than usual. So normally there's deals being done right through until Christmas Eve. Most agents sort of packed up their bags in the middle of December and they stayed off longer. So January, we didn't come back to market until after Australia Day weekend, which is fairly normal, but we'd normally start seeing a little bit of activity at least the week beforehand, but that wasn't the case. So I think everyone sort of hung up their boots and took a well-needed break from, I guess, what's been a pretty tough year in the Melbourne property market. Sentiment was low. It's certainly on the improve. Those numbers that we see on the screen just are not accurate when you're looking at submarkets or markets within markets. Yes, it's a picture of Victoria, Melbourne, but it just isn't an accurate depiction of what's going on in certain markets. So if we look at sub $1 million, which we don't do a huge amount of work in there, but that market is flying. There is so much property being sold. And that's because there's obviously for first home buyers up to 950,000, you can get a 5% deposit that's been government granted. So that's making an impact on the first home buyer market. If you look at anything sort of where we do a huge amount of work, sort of that 3 to 10, 5 to 7, in that sort of sphere, there's just a lack of supply. People are sitting and holding. So when we do get a good home that hits the market, it's moving because there's people who want it, and there's less supply. So therefore, there's really good competition. We're also seeing properties that were on market last year. They went to full campaign and perhaps didn't sell. They've now been reintroduced to the off-market market with price adjustments, and they're performing really well, or actually exceeding their expectations because the resting's served them well. So I think that you need to look, you can't look at it as a whole. You need to be thinking, if you're looking at the data for Melbourne, you need to be looking at the particular locations in which you're looking to purchase.
Yeah, Chris, how does that translate to your market?
Yeah, so I've actually got all the CoreLogic data. So being in the media, I get all the data from CoreLogic back to 1984 for all the states, and it breaks it down by houses, units, and dwellings. And that's the thing is when you see these graphs, that is just a dwelling value. So there's houses in there, there's units, there's ones in the middle of nowhere, there's blocks of 1,000 units, and there's blocks of 6 right by the beach. And so that's the thing is all of these markets work completely differently to each other. So you're seeing averages there. Whereas if we're buying in good areas and you're buying at a good price, maybe on valuation, you're generally going to beat those kind of averages. And again, is what they're saying in a lot of these reports that I'm creating is that quite often there's a time lag with, say, houses and units. So houses will suddenly go up and then units will take on afterwards. And so suddenly you expect the upswing. But also it's all about consistency. So Perth is a classic one. If you look at the median value of Perth from 2007 to 2021, it did absolutely nothing. So if you were there, you were sitting on your hands doing nothing. Whereas if you're in Sydney, Melbourne, or Brisbane, no matter what there was happening there, you could still refinance, pull out the equity, and keep repeating. So yes, Perth has doubled in the last 5, 6, 7 years, and the long-term average is similar to Sydney, Melbourne, Brisbane. But it's all about consistency rather than those one-offs. And this is what you get in the media. The current affair, the Instagram, the Facebooks, you'll see this doubling and people say, oh, I've made all this money. I had a client the other day saying, oh, I can buy up in Brisbane and get a 15% yield, capital growth. I said, yeah, but you're not going to be getting that for 30 years. So you've got to look at the actual numbers and understand the numbers behind it rather than just looking at one-off figures.
Yeah, I think if we look at any growth rates from the last 5 years in the post-COVID environment, everything looks great, right? But again, we're not in this for short term. You know, that could realistically 5 years is still pretty short-term thinking when it comes to the property market, in my opinion. Yeah, typical old wog saying that, Italian background coming out in me, I guess. Lauren, one thing I wanted to touch on with yourself is what you're seeing from a rental point of view. Mass exodus of investors has been something that was talked about a lot in the media. What's that mean for you on the ground when it comes to tenants, rents, all that sort of stuff?
Yeah. Look, it's really interesting. I think we've gone from one problem to another, essentially, in the housing market. So we've got a rent roll. We manage about 800 properties, and we've never given out more notice to vacates for sale than we have over the last quarter. It's the greatest amount we've historically had in the last 18 years of running the business. Now, the reason for that is a couple of things. We've got some people who are just at the end of their life cycle of holding an investment property. You know, they're going into retirement. Then we've got others that are just like, because of the onerous matters in which they've got to manage their properties to the changes of legislation in Victoria, they no longer want to have the dramas. And then you've got people dealing with land tax, and we're basically being taxed on everything at the moment so our government can reclaim the debt. So people are just jack and they're selling. But what that means is that when we've got open for inspections for our rental properties, we've got in excess of 50 people registering, and we're actually having to cap the numbers. Even last night, I got a text message from a friend saying, look, I've got a friend wanting to rent this property. Can you put in a good word for me? It's really brutal out there. And these are people who own their own houses. They rent a property in Elwood. They just can't get anything. It is really bad. So we're going to see a lot of people displaced, and it's putting pressure on rents. And obviously, because of how hard it is to move a tenant on, the people are making sure that they're getting as much as they humanly can when the properties are becoming available. So it's having a real flow-on effect. It is a great time for investors, right? You know,
I was going to
exactly
say,
more inquiry from investors, expats, and people overseas and interstate ringing us because they can see that it's now a really great time to be entering the market. We are still soft, but it is shifting, and the metrics are changing, and it is now, although it is quite onerous if you get good management, the taxes and whatnot are going to be, there'll be a mute point when you look at the growth that where people are expecting to see in the long-term investment home.
Yeah, for sure. I just think everyone's going to put up barriers as to why they don't do things. People put up barriers as to why they don't go to the gym, why they don't quit smoking, why they don't eat healthy, whatever it might be. This is just another one of those barriers. If you've got the right team around you, as you said, property management and buyer's agency like you have in-house, to be able to assist in that from start to finish, it shouldn't be a headache, right?
No.
It shouldn't be a headache. It's a business, and you outsource, and you have staff to run that business in your property business. And that's the way, you should definitely be looking at it as an investor for sure. Just one last topic. I know Chris you wanted to have a bit of a chat about, we're seeing more and more software coming out to, I guess, assist investors and assist buyers agents in administering services. Tell me about one you've come across.
Yeah, so in all the years, we've always stayed with fairly basic Excel, like I've got in my books, some basic examples. And I think most people get too detailed into Excel that they can't see the wood from the trees, and they miss the point, and it gets so complicated. So I still think that basic Excel of thinking about property doubling every, say, 7, 10, 12 years and having some basic numbers is the way to go. However, there's a lot of people now saying, look, I want to retire on 100 grand passive income a year, or 200 or 300 grand. And it's very hard to do that with Excel to actually see where you're going to be. So we've managed to get hold of some software that we've just been testing, been using it on myself, and we're just putting it out to clients now, where you can actually go and do those predictions. Now, the great thing is you can put in the variables that you want. So you can say, I believe capital growth is going to be 5% or 7% or 2%. Whatever you want, and interest rates, you can put in your actual home loan repayments and everything else. And what it will do is right, okay, if this is your position right now, in 20 years' time, this is what it's going to look like based on those variables. And if you sold off your property, this is how much cash you're going to have and how much you're going to have to live off. And the idea of doing this is to say, for some people, they've already got so much equity, they actually can sit back and not do anything else. And like a book, Die with Zero, which is becoming more and more famous, there's a limit to how much money you need. So for some people, that means that you might be able to chill out now, and for the next 10 or 20 years, realize you've got enough, you've got comfortable money, you've got some buffers. But for other people, it says, you think you're going to be all right, but this is what you're going to look like in 20 years' time if you do nothing else. So for those people, they need to get off their backsides and actually go and do something. And so I think it can work for all types of people, and it will give them a good insight into where they're likely to be when it comes to retirement, or if they're trying to retire early.
Yeah, for sure. I think also as well, and one thing we spoke about off air on this is obviously this does not necessarily replace the role of a quality financial planner or accountant. It probably is a way to dip your toe into more knowledge and get the conversation starting to then do those further investigations. Would you say? Or
Oh, look, 100%. So it's a tool, just like Excel. And tools make mistakes, so does Excel. And so what you've got to do is, when you go to a financial planner, quite often that plan is pretty static and it's not properly concentrated. And so, sure, you might go back to your financial planner every year and just get a reassess. But this is a way of getting it very, very property specific. But as I always say, check it with your mortgage broker, accountant, licensed financial planner, and all of those people, because otherwise you don't want to get to ahead in 20 years and say, hey, where's my golden egg? And suddenly it's not there.
yeah, the goose stopped laying 20 years ago because you stopped investing. So that's it. Well, look, thank you very much, team. And I guess from my side of things, we're seeing Brisbane and I guess Southeast Queensland in general really starting to pump as far as the capital growth, as you've seen in those statistics. But on the ground, we're definitely seeing a lot of opportunities like we see in each marketplace. So if you're looking to make a property move in 2026, please reach out to Chris Gray from Your Empire in Sydney, Lauren Staley from Infolio and Your Empire in Melbourne, and myself, Zoran Solano from Hot Property Buyers Agency and Your Empire in Brisbane. Thank you very much, everyone.